From the Lineweaver Wealth Watch Center, this is the Financial Quarterback.
I'm Jim Lineweaver, your financial quarterback since 1993. You know, the IRS issued a new revenue ruling this past March affecting irrevocable trusts. It raised all kinds of red flags with accountants, financial planners, and attorneys across the country. So here to help us understand the ruling is Laurie Steiner, partner at Solomon, Steiner Peck. So Laurie, where do we get started?
All right. Well, first of all, revenue ruling is a determination about the tax law that's binding on both the IRS and the taxpayers. They're needed when the tax law itself might be kind of complicated to understand. They can also arise when a taxpayer has a question and the IRS disagrees and they need clarification on that. So another way that the IRS can make a determination on taxes is issue a private letter ruling. Now that's only for one question or a question for one taxpayer and is only binding on that one taxpayer.
Now, sometimes advisors undertake estate and Medicaid planning to remove assets from a person's actual ownership to avoid income or estate taxes or for Medicaid eligibility purposes. There's two types of laws, basically for income and a separate one for estate taxes.
In this particular letter ruling, the taxpayer set up an irrevocable trust to remove the assets from their estate. Now, normally an irrevocable trust pays the income taxes on that trust that the trust earns, and the assets are not part of the estate for estate tax purposes. However, the taxpayer added special language into this trust to force the income taxation to be taxed to the person setting up the trust instead, making it defective as to the normal income tax rules for the trust.
And this is also good for the taxpayer because the tax rates for people are much lower than for trusts. That taxpayer also tried to avoid capital gains on the appreciated assets of the trust by claiming that just having the income tax to the taxpayer was enough to allow the capital gains to be wiped out at his death when the trust was distributed, called a step-up in basis.
Right. So there was a private letter ruling in this case for that taxpayer only explaining that the income tax was taxed to the person, and because of that, there would also be the step-up in basis. Planners started using this language in all their trusts, and it turns out that the IRS didn't like it very much, so nobody knew why. So one of the things that's a problem is the letter ruling was only for that one person, and the second issue is that the IRS actually has determined that the law was not the way that they determined it in that private letter ruling.
Yeah, so the IRS issued these new revenue rulings to explain the correct use of the law, and they also provided the language for it too.
Thus, after this ruling, it's clear that if the taxpayer sets up an irrevocable trust so they don't actually own any of the assets, there is special language. You need two sets of special language to get the favorable income tax rules and the favorable estate tax rules.
Sounds very confusing, and that's why people need a specialist like you. So thanks, Laurie, for explaining this new ruling. So as you consider the language of your irrevocable trust, Laurie and I are always here to help. If you have any questions, give us a call. Here's Fox News Sunday.